Index funds have long been considered an easy way to gain exposure to the stock market, and since the rise of ETFs, or exchange traded funds, they've been getting more and more popular with investors. This isn't everyone's opinion, however, as there has been some criticism towards index funds, with one commenter on Damien Talks Money saying that index funds have high fees and this can impact the compound interest you would have earned. And yes, it is true that every product that you can invest in will have some form of fees attached to it, whether it's trading fees, stamp duty, management fees, there are multiple things that you could be charged for. But are index funds expensive? Let's take a look at all of the costs involved when buying index funds and ETFs and see how they compare when investing into individual stocks. The first cost associated with index funds is the ongoing annual charge for managing the fund, and this can be known as a number of things, including the OCF or ongoing charge, the TER or total expense ratio, and the name will vary based on the broker that you're using or where you're located. This fee will be taken as a direct percentage of your investment and can vary massively, but usually falls between roughly 0.01% and 1% in most cases. Each fund will have fund managers, and this fee is simply covering their work in overseeing the fund, so nothing too shocking here. However, it is important to always be aware of this fee, as it can have a huge effect on your returns. A 1% charge might seem small at first, but it's when you look at how that affects your investment over a number of years that you'll see the real impact. We'll look at the effect of the ongoing management fee on compounding value a little later in the video, but for now it's just important that you know what this charge is and what you can expect to be paying. Ideally, a lot less than 1%. Another fee that you'll encounter when you buy index funds or ETFs is the broker fee. And again, this can range quite a lot depending on who you choose to invest with. Most brokers will charge you a platform or account fee just for using them to trade with, so you'll need to include this into the cost of the index fund when considering. Sometimes this fee can be a percentage of your investments, or you might be required to pay a flat upfront fee for yearly or monthly usage. These brokers then often take commission on trades as well, meaning that every time you buy or sell a share or fund, you will pay a percentage of that directly to the broker. A bit like with the ongoing management charge, but you're paying the platform you're using instead of the fund managers who overlook the fund. These costs are somewhat avoidable though, as there are brokers out there who offer commission-free trading and won't charge you anything for using their platform if you use them in specific ways. Again, it's important to do your own research on each platform and fund before making an investment. I also only talked about DIY investing, so if you want to use a managed service, then the prices will be higher. If you want to simplify things and narrow down brokers more easily, I've included a link to a free cheat sheet in the description below which compares the main brokers, their fees, and their funds. Please also remember that none of this is financial advice and we are not financial advisors. None of the funds or brokers mentioned are recommendations and all investments do have risk. Despite some brokers offering no platform or trading fees, sadly you'll still have other costs to consider when buying index funds. A charge that you'll encounter when investing into a fund priced in a different currency is the foreign exchange or FX fee. Some FX fees are as low as 0.15%, so if I were to invest £1,000 into a fund that wasn't priced in Great British pounds, I'd incur a charge of £1.50, and this fee will grow along with the size of your investment. Other brokers' FX fees can be higher, so you could end up paying £5 to £10 here. A slightly more significant fee that you could face is tax on any dividends you make from your investment. Unfortunately, the amount of tax-free dividend income has decreased dramatically in recent years, falling from a threshold of £5,000 in 2016-17 to now only £500 at the time of recording. This means that if the dividends you receive from your investments exceed £500 within the financial year, you will be required to pay dividend tax, and this tax will vary based on your tax bracket. If you're a basic rate taxpayer, you will need to pay 8.75% in tax until you reach the higher rate in terms of total income. On the higher rate, it will be 33.75%, and this increases to 39.35% for those paying the top additional rate of tax. However, just to be clear, this will not apply to you if your dividends are below that £500 threshold, no matter what tax bracket you're in. But be sure to keep this in mind as a potential cost of investing into distributing index funds. Having said all of that, you can avoid that tax altogether by investing within a tax-efficient account like an ISA or a SIPP. A tax that you can't avoid when investing though is stamp duty. Fortunately, this only applies to individual stocks, not funds, so this is a win for index fund investors. Stamp duty tax also only applies to UK stocks, for example BP, so you won't pay this when buying shares in any foreign companies. But this is quite a significant factor as it comes to 0.5% of a transaction's value. So for every £1,000 you invest into UK individual stocks, you pay £5 in stamp duty. Moving on from taxes, bid-ask spreads will be another cost to look out for. And this is the difference between what someone is willing to pay for an ETF versus the price that the seller wants for it. And this difference in price will be a cost when buying the fund. The most popular funds that are traded the most will have tighter spreads, meaning that this cost will be minimized, so it all depends on what fund you're buying as to how much you'll have to pay. Also, this only applies to ETFs, not index funds, as they have a single daily buy and sell price. These fees might all sound small, but let's see how they could potentially add up over time and see how much it might cost us. Earlier, I mentioned that the ongoing charge can be a significant fee to consider when looking at a long-term investment. So how much can this affect compounding? Even if two funds are practically doing the exact same thing, you could be looking at different management fees based on who the provider of the fund is. For example, the SPDR S&P 500 Distributing Fund charges 0.03% for the management fees, whereas Vanguard's VUSA fund, which also tracks the S&P 500, charges 0.07%. So to gauge this impact, we're going to look at 3 different charges and compare the differences over a 30-year investing period, where we invest £10,000 a year with an average return of 7% each year. With a 0.1% annual management fee, after 30 years, you're looking at roughly £11,000 worth of fees to pay, and a total difference in your portfolio's potential value of £21,155. If we change that annual fee to 0.5%, you end up paying around £52,000 in fees, and would lose out on £101,227 in your portfolio's value. Then, finally, a 1% annual fee would set you back almost £100,000 in fees paid, with a total potential portfolio value difference of £191,830. As you can see, the small differences in fees add up massively over time. Now, these numbers all sound a bit scary, but in fact, even a 0.5% ongoing management fee would be on the more expensive side when compared to most funds. Sometimes it's unavoidable, especially if you want to invest into less popular or more specific funds, but if you do your research, you could end up paying a lot less than this. And even if you were to pay a 0.5% annual fee, your investment's profits would still come out at over £650,000 in the example that we looked at earlier, which is 13 times more than the amount you'd have paid in those fees. Do remember though that this was just an example and all investments have risk, and that past performance is not a reliable indicator of future performance. When looking at the alternatives, individual stocks won't require you to pay an ongoing management charge, but that doesn't mean you won't need to consider other costs. For one, you could incur a trading fee every time you buy and sell a stock, but again, this depends on the broker that you're using, as there are some out there that charges 0 commissions on trades. However, it's unlikely that you'll avoid all trading fees, considering most popular shares are priced in US dollars, so you'll have FX fees to contend with. You also have that stamp duty to worry about if you're buying UK stocks, but this can be avoided simply by steering clear and sticking to foreign companies. There are some other small fees that you can incur that I'll put on screen for you to read through now. Overall, index funds can be cheaper than individual stocks, but they can also be more expensive. But the question was, are they expensive in general? Well, in our humble opinion, no, not really. The appeal of an index fund is that you gain exposure to hundreds, if not thousands of companies in just one investment. And these aren't companies that you've had to go out and manually pick for your portfolio, as they're all just part of an index that's being tracked and invested into by the fund. And if you wanted to go out, buy shares in hundreds or even thousands of companies, and continually buy and sell them so your portfolio matched the index, it's likely your fees would be substantially higher than just buying the index fund that does the job for you. And this is especially true if your value is time. Fees will also eat into the amount that you can potentially earn in compound value, but that's unavoidable. However, if you manage to generate a significant return on your investment, fees will often only make up a small percentage of that return. If you'd like to learn how to invest into your very first index fund, you can watch the tutorial that I've put on screen for you now.